welcome our supporters of iSTOX as well as Indies Capital partners. Thank you for dialing in for today's fireside chat on opportunities for alternative capital in the post-COVID-19 world. Before I begin, I'd like to start with a disclaimer that this is actually not an advertisement making an offer or calling attention to an offer or intended offer. This is purely informational. Everything here shared today is for your educational purposes, and we are very happy to have Indies Capital Partners here with us today. So a bit about Indies Capital Partners is that it's a leading alternative asset manager focusing on Southeast Asia, especially for Indonesia. It's established in 2009 and they have invested over $1 billion US. Now they currently manage over 600 million US dollars in total assets, commitments, and also co-investments. They are fully regulated by the Monetary Authority of Singapore. In 2017, they also formed an alliance with other partners, which is a global alternative investment manager firm. I'll first start by introducing our first speaker, Mr. Danny Gunawan. He's the managing partner and founder of Indies Capital. Prior to setting up this fund in 2009, he was the managing director of the Southeast Asian head of special situations at Citi and Salomon. Prior to Citi, he's actually held various credit analyst positions in very reputable institutions across the world. The next speaker is Harold, who's previously a director at the Carlyle Group. The Carlyle Group is actually one of the world's leading private equity investors, and his last role there was being the head of Indonesia, Singapore, and Malaysia coverage. Prior to Carlyle, Harold had a stint in the Credit Suisse investment banking division in Singapore. Today's webinar is brought to you by iSTOX. And at iSTOX, our vision is to give equal access to financial markets through a regulated, transparent, and community-driven platform. We do so by creating a platform for investors like you to invest in private market investments like hedge funds, private equity, and pre-IPO unicorns. So what you can do on iSTOX is actually subscribe to primary offerings to such exciting listings that you don't usually get elsewhere, all in one place, because you are also open to being able to trade in the secondary market. So I think that's our short plug about iSTOX. This is a webinar in a series of investment series with reputable fund managers across the region. And today, I'd like to pass the time over to Mr. Danny to kick off the presentation on alternative capital with Indies Capital Partners. Thank you.
Thank you, Nigel. Hi, everyone. Thanks for attending this event. Let me start by give you a quick overview on Indies. As mentioned by Nigel, Indies has been around for about a decade now. We are an alternative asset manager, headquartered in Singapore. The team is consisting of 17 strong individuals, consisting of 14 full-time professionals and 3 senior advisors. We are split almost equally between 2 offices in Singapore and Jakarta. And the team is led by 4 partners with an average experience of 20 over years. Some of us has gone through multiple cycles, including the Asian financial crisis. In terms of AUM, we are currently managing more than $600 million US dollar, split almost equally between blind pools funds and co-investments by our investors. And we managed to generate very good returns to date and rank first quartile by Preqin. And of this 600 million AUM, the majority of our business is still in the mezzanine, which is how we got started and is continued to be our bread and butter business. But in recent years, we've been starting investing in private equity, and it is a growing part of our business now. In addition, as mentioned by Nigel, we have a strategic alliance with Farday Partners, which is a global alternative asset manager headquartered in the US and focusing on mezzanine opportunities in this part of the region. Another alliance we have is with AC Ventures, which is an early stage venture capital fund. And this is more related to our tech sector investments, in the sense they will fit into our late stage tech investments. I will hand over to Harold, who will talk about a few more slides.
Okay, thank you, Danny, and thank you, iSTOX, obviously, for hosting this event. So just to continue on in terms of an introduction to Indies, this is the two strategies that we invest in. Mezzanine, on the mezzanine side, we have three closed-end funds, Indie Special Opportunities 1, 2, and 3. And you can see the structure here is essentially a loan of medium tenure, 2 to 4 years, and generally with security and collateral of some sort, right? The investments are US dollar denominated, very high yielding, and some also have an equity kicker or an equity upside. Generally, the influence through the business is through board representation or through operational financial covenants, as well as the collateral that we hold. On the private equity side, it's actually a very niche private equity strategy, so it's not a typical private equity fund per se. The strategy that we look at here is to create a very diversified pool of technology assets within Southeast Asia by targeting the secondary share market. So we purchase shares from other shareholders in the mid to late stage. So it's not really venture risk per se, but more growth risk in terms of technology companies. And the idea, therefore, is to provide liquidity, particularly to earlier stage investors here. So it's a very niche private equity focused technology exposure type of fund. Okay. And it's something that, as Danny mentioned, is relatively new for Indies, starting in 2018. So I think to start off with, and to answer the topic of the opportunity set here in alternative financing, we do see mezzanine as an alternative financing source. It's not as prevalent, certainly, as senior debt or equity funding. So to start off with, we just thought we'd highlight where it kind of sits within the capital structure and the gap that really we're filling in the market. So the good thing about mezzanine is that we can fill both at the operating company funding needs, as well as an equity replacement tool, or to help with equity liquidity at the shareholder level. So at the holding company level, we really call it holdco mezzanine funding. And at the operating company, we call it opco mezzanine funding. And the key differences, if you see on the right-hand side of this particular chart, compared to senior debt, the first one is obviously that flexibility, right, in terms of the structure. And then if you look at the repayment source, there's also more flexibility. So apologies, brother, the mezzanine and senior debt labels are actually the other way around. So the top of it is actually senior debt, and the bottom it should be the mezzanine. Where mezzanine targets returns really in the high teens to low 20s, and with some upside kicker in some deals. Okay, so that's the basis of where mezzanine sits in the capital structure. To compare it to something which perhaps is more familiar in terms of private equity investing, I think we look at the use of proceeds, and it's slightly different. It can fulfill needs of sponsors as an equity replacement. It can also fulfill needs of liquidity at the company level, as we've discussed earlier. Compared to private equity, which really is either a growth equity funding or buyout of businesses. One key differentiating factor particularly for Southeast Asian investors, given the mix of different economies and currencies within our region, is the fact that we are US dollar denominated for the most part. So the fact that we're US dollar denominated has really helped, I think, mezzanine in terms of returns when country FX is depreciating, particularly in emerging nations within Southeast Asia, such as Indonesia. Okay, the target return is high teens in the mezzanine side, and with the equity kickers, generally that ends up being at over 20% in terms of the target. And on the private equity side is generally low to mid 20s, right? But a lot of it is variable, okay? Versus on the mezzanine side, which is fixed. In terms of investment horizon, it's generally much shorter. So we take a medium term, 2 to 4 years, versus private equity, which is generally 4 to 6 years. And often in Southeast Asia, the holding periods are even longer, right? Because the capital markets are not as efficient, and the exit avenues are probably lesser compared to Western markets. On the mezzanine side, we also have downside protection in the form of either collateral via assets or shares of companies themselves. And often you can also get personal or corporate guarantees and a cash sweep mechanism, which is an added layer of protection to ensure that repayments are captured within the operating company cash flow. In terms of distribution or the ultimate exit, it is more flexible because it's not reliant on either the capital markets or a sale event happening when you compare it to private equity. So there's more consistent distribution, and generally that results in a fund investment which does not have a J curve because of the underlying investments continually distributing and having a finite tenure. Okay, so that really helps with both the distribution and the exits. Now, to take a step back and to have a look at why this product really does exist in a big way, particularly for Indonesia, we'll take you through some regional overview as well as a view within the capital markets and the financing markets. Because of all the countries in Southeast Asia, this particular product actually is probably most prevalent within the Indonesian context. Okay. Now, I think most people know the Indonesian economy is the largest within Southeast Asia. And it certainly is very much a domestic consumption story. And I think most people will know that this year in particular, 2020, the growth rate that's been exhibited in the last few years within Southeast Asia will finally come to a halt due largely to COVID and the recessionary impacts of that. I think the one country that has done the best is obviously Vietnam, who may actually stave off a recession this year. Importantly, I think the forecasts for the future remain pretty bullish overall for Southeast Asia. And you can see most economic predictions are that it will bounce back relatively quickly. At the same time, most nations in Southeast Asia has buffered the impact of COVID by adding stimulus in the market. So we've seen that both above the line and below the line in terms of fiscal as well as monetary policy. And I think that's across the board. This will, I think, lead to some sort of a delay in terms of some of the real economy impacts. So I think, we may see even more opportunities on the alternative capital side as companies face headwinds in the future. Okay. Currently, there's a little bit of a buffer due to the stimulus provided by governments. Indonesia in particular has taken the recent step to improve the investment environment and to promote really the investment environment. This is through the launch of the Omnibus Law, which signifies significant reforms, particularly to the business sector. It's added incentives for particular business sectors. It will remove a lot of the negative list, and the negative list is really for foreign investment into the country in particular sectors. It's trying to centralize government standards and really remove inefficient bureaucracy. And perhaps the most important is really the changes to the manpower law. So it's really reforming the labor law in order to make it more competitive and more balanced in terms of the labor versus the business relationship. Okay. Now, the crux of why mezzanine capital and alternative capital exists in a big way in Indonesia is the story that we will tell in the next 3 slides. What you'll see is that the Indonesian economy and Indonesian entrepreneurs and sponsors and business groups are really starved of sophisticated capital. And the reason they're starved is because the depth of the capital markets, as well as the overall leverage available in the financing markets, is actually relatively low. And that's not compared to developed Western nations, but even the rest of the Southeast Asian nations. So if you look at the economy in terms of financing, bank loan as a percentage of GDP in the top left-hand chart on this screen is extremely low. It's less than 1/3 of GDP, which is the lowest within all the Southeast Asian nations. And the impact of COVID within this environment is really to even tighten credit underwriting further. So we think it'll dampen loan growth. We've already seen that in the first 7 months of this year. You can see aggregate loan growth at the top banks has declined substantially. It's basically flat. And at the same time, the loan loss reserves are expected to increase and restructured loans are expected to increase. So again, this creates an issue within the financing markets where it's not that easy to access. Okay. There are also a lot of policy-driven restrictions in Indonesia. So an LBO style loan, for example, is unlawful there, where you're effectively levering up the company that you're buying shares in and using those shares to lever up. That's not allowed in Indonesia. And there's a lack of sophisticated capital, particularly in mezzanine within the operating company. So when you compare this to Western nations, where you can get junior debt or second lien debt within the operating company, that's not very prevalent in Indonesia either. The other side and the other alternative for companies is really then to look for capital market solutions, whether that be debt capital markets or equity capital markets. And what you see, unfortunately, is pretty much the same story. So local currency corporate bonds, which is the top left-hand chart, and US dollar corporate debt, which is the top right-hand chart, I think both showed that penetration in Indonesia is still very low. So the capital markets are not that well developed. And again, the impact here of the pandemic-led shock is to really create a bigger delta between good issuers and those of the next tier, right, in terms of the credit tier. So there's a widening in terms of pricing and the gap. So for the mid-tier issuers, again, it's going to get more and more difficult to access this market. In the equity capital markets, what you see in terms of year-to-date performance is very different from what you hear, particularly versus the S&P 500, for example, where the Jakarta Stock Exchange, the composite index is down almost 30% on a year-to-date basis. What this means is that valuations are depressed. You can see the price to book chart on a year-to-date basis. But even in the best of times, so if we look at the top right-hand chart, public equity issuance over the last 5 years, which really was a great time, I think, for equity markets as a whole, Indonesia is well underpenetrated and underrepresented at only 0.5% of GDP in terms of new capital that's been put into the equity capital markets. Okay, so this is primary issuance on the stock exchange. So it's very, very underpenetrated. In this current environment, the attractiveness of issuing new shares will be even further dampened, given that the stock market is down. So this is really where the opportunities lie for alternative capital providers, right? There's already a market dislocation, as we've seen, created by inefficient banking markets in terms of financing, as well as equity and debt capital markets. And the pandemic will either reduce this, remove access, or tighten credit underwriting even further, right? So in what was already an under-levered economy, you see that things probably get tightened even more. Sponsors and business groups themselves have a reduced capacity to self-fund, particularly when equity valuations are actually down. And private equity is often a less attractive alternative, again, given the markets are down, right? And they take a very long-term view. So for alternative capital, the opportunity set here is to be a proxy to private equity returns. So as we've seen, the targets are 18% plus type IRR in general for mezzanine, but you have a lower entry multiple because you have downside protection. Right? During this period, given the pandemic-led shock, we can cherry pick better credit, better sponsor groups, and take a more conservative view even on the collateral package that you have. And so we think it serves to look at a 2 to 4 year investment horizon. And I think it'll be better served even for partnering with business groups where you have certainty of cost within a 2 or 4 year investment horizon. Alternative capital and mezzanine can also be used for opportunistic rescue financing, but generally compared to Western world special situations, we avoid distressed company situations because you don't have the time or the tenure to go into these companies. So one misconception people often have is they think that this is distressed and special situations lending. But that's not the way we look at the market. In fact, it's more of a partnership angle. And you see that here in the next page in terms of the target situations that would make sense for mezzanine and alternative capital within this space. In the middle circle, what you see is really the target investee. First and foremost, again, there's a misconception that to get these types of returns, you have to look at perhaps SMB lending or smaller groups, but that's generally not the case. A lot of the deals done are with groups and businesses worth $500 million or above, for example, right? And we generally target, I think, with this particular product, either businesses with very high growth or with strong support from the sponsor or high cash flow generation from an underlying asset. Okay, so that's the target companies. On the squares that you see on the outside, it shows really the situations, okay, where mezzanine capital can really help. So it can help a sponsor or business group look at acquisitions or expansion capital, right? Particularly when assets are attractively priced at the moment, okay? Or when they need working capital for expansion, but they're restricted because of the current market situation regarding access to financing. Okay? On the bottom squares you see, there are other situations also where it's more about liquidity needs and helping to fundamentally close the gap on liquidity issues. And that comes up in situations where you need refinancing. Perhaps you need rescue financing because a particular sector is hard hit, or in debt buybacks situations. So you can see that it can be useful both in new capital injections for growth or for opportunistic acquisition, or for refinancing, or as a replacement to liquidity needs when the market dries up. Now, the target sectors, I think it kind of follows the prior page in terms of how capital is used. What we've seen is with the COVID impact, it's actually differentiated between different sectors. So we've seen sectors such as logistics and infrastructure that have actually benefited from this. One area is obviously with increased online adoption as an example. So the tech sector in particular, where we've seen increased activity on the e-commerce side, lead to increased activity in logistics and the need for infrastructure there. And so the use of capital here will be in attractive targets that need funding for either capacity expansion or for acquisition, as we discussed. On the other side, there are sectors which are negatively impacted, being property, commodities, or the consumer sectors as examples, right? And this is where alternative capital can be used to either shore up liquidity and give businesses the room and the runway really to be able to pave the way for an eventual recovery as the economies recover in the next 2 to 4 year cycle, right? Or it can be used for opportunistic acquisitions and consolidation during this time. Now, an interesting and growing sector within mezzanine financing is actually for technology-based businesses, okay, particularly for businesses that are a bit more mature. So people on the call may be familiar with venture debt. Venture debt is really kind of the first debt companies can get even as startups, but it's generally very small ticket, right? I think mezzanine for technology companies is a slightly larger ticket size and should really be seen as an equity replacement tool where companies don't want to dilute themselves perhaps so much, or as a runway extension, right? So you don't have to continuously do equity fundraising. You can also help your runway by providing some mezzanine financing. And the key differences with a more traditional mezzanine product is really in the return component, because these companies potentially have a lot of upside. So you may structure the mezzanine deal with higher equity, either through free shares or warrants or equity kickers. I've spoken about the target situations. They often differ a little bit because it's really an equity replacement tool, right? And the target companies themselves are really later stage technology businesses, those that are really already revenue generating, backed by strong institutional shareholders. Right? When we look at the downside protection, because it's also an earlier stage company, generally the bar is set much, much higher. So we do look at how much equity has actually been put in at these companies, not just the valuation or the last round valuation, if you will, but actually how much dollar equity has been put into businesses, because that's the equity buffer, which is really behind the debt here. And often we will require additional collateral above 3 times the amount of debt that's put in, as well as corporate guarantees, personal guarantees. And interestingly, you become, because this is really the first debt, you become the most senior within the company in terms of the capital structure. Okay. So as a summary, we think that alternative financing solutions does present a fairly compelling asset class, particularly within Indonesia in the Southeast Asian context. Dislocated capital markets definitely presents a lot of opportunity. We've already seen what COVID has done to the loan markets as well as the debt and equity markets, right? There's a high cost of issuance there in terms of equity. And of course, the debt markets are more restricted given current market conditions. So there's opportunities as companies seek for funding. We believe mezzanine provides a very attractive risk-adjusted return profile, particularly if you can target PE-like returns, but in US dollar denominated pieces of paper with additional downside protection. So it literally means you enter a business at an implied lower entry, right? Because you hold collateral. And you can also structure equity upside given the current depressed equity valuations. And in terms of distribution and exit, generally it's a much shorter tenure. There is a defined maturity period, right? And there's also no J-curve effect, which is something that you see more in traditional private equity. Okay. So thank you for listening in to our presentation. Maybe I will hand it over back to the iSTOX team.
Thanks, Harold. It's a very insightful presentation. I think I learned a lot more about mezzanine and how it's actually being implemented, as well as the opportunities and risks even within the COVID situation. I think before I open the floor to the Q&A, I myself have a few questions. So I think the first question goes out to Danny. The question is, operating a mezzanine fund seems to require a lot of industry experiences in terms of like negotiating and bespoke processes. So I think the question is, what are the certain lessons you have learned by since the fund inception in 2009?
Okay, thanks, Nigel. I think from our experience, the success formula that we found is a combination of good structuring of the deal, right? Obviously, it starts with a credit analysis of the underlying company, and then followed by good structuring of the mezzanine product itself, especially with regards to the downside protections and the serviceability of the mezzanine itself. And then a second element, which is equally important, it's a relationship with the counterparty itself. That's why at Indies, we believe in a strong local presence and source as much as possible of our deal directly, so that we have a direct relationship with the counterparty instead of through a middleman. So I think it's a combination of the good analysis, strong structuring, and strong relationship. It's been proven to be our good formula to make good investments in this sector.
Thanks, Danny. The COVID situation seems to be producing like opportunities and risk. I mean, for the capital markets and debt capital markets, it seems to produce quite a bit of risk. But in terms of mezzanine financing, what are the opportunities and risks that, what are actually the risks you foresee going forward?
Okay, so I think the risk is obviously on the economy, the general economy itself, right? I think as you understand, all economy, including Indonesia, it will be hard hit by the crisis, by the pandemic, especially in the next 1 or 2 years. So I think it's very important for us to cherry pick the deal, right? And support the company that is more likely to survive the crisis in the long term, and avoid the pitfalls of the company who is unlikely to make it. I think that's the general rule. So requires a lot of analysis, probably more so than before. Okay, and secondly, I think we also need to be patient, because the impact on the real economy, it's probably takes some time to materialize into the company's performance, given the the stimulus that has been given by the government, and also the relaxation that was given by commercial banks in terms of restructuring. So we feel that the real impact has not been fully shown in the company's figures. So I think it's a again, it's more analysis and more forecast about what will happen when all this stimulus package and all this support start to be reduced.
Yeah, I think Danny is very comprehensive on the answer to this question about risk. I think before we open the floor to a lot of questions, thanks to the audience, there's a lot of exciting questions coming up. But before we open the floor, I would like to have one last poll question on what do investors tuning in today want to look for in alternative investing. Showing the results now. Whoa. So I think everyone, more than half of the people here are very excited about alternative financing and mezzanine funds, followed by private equity and then unicorn startups. I think in this current COVID situation, it's quite fair to see that people are moving back towards more resilient forms of investing as well as lower volatility asset classes. That's a very good insight. So now I'll open the floor to Q&A. First question is very interesting. Somebody anonymous asked, for your PE growth equity strategy, what is the benefit of going through a secondary share purchase kind of strategy?
Sure, let me answer that one. So as we mentioned earlier, we do have this second fund strategy, which in a sense is also alternative because as suggested, we go and build a portfolio through the secondary share market of privately held tech companies. So in a sense, it's still very illiquid, okay, and it is very, very private, and cap tables and shareholdings of these entities are generally kept very, very private and confidential, right? So the reason we come in on the secondary side is for a couple of factors. I think on the demand side, if we were to go in and try and buy these companies who are already growth phase companies with, somewhere around $5 to $10 million kind of check sizes, it'll be very hard to get in because the company is already quite big. As we're targeting companies Series C and above, it makes it very difficult to do so unless you have very, very big funds willing to do primary shares, because then the money goes into the company. But when you're trying to build an index, right, which is really fundamentally building an exposure across the board on big Southeast Asia tech businesses, it's actually easier to do it on the secondary share side because you're also fulfilling a need on the supply side. And what I mean by that is that if you think about the tech ecosystem in Southeast Asia, it's about 8 to 10 years old for even the first kind of generation companies. But very few of them have exited or created an IPO, which means there are a lot of early stage investors, there are a lot of management teams, there are a lot of founders sitting on ESOP and shares that are illiquid, right? So we actually help that illiquidity problem. We help to buy some of these shares and to give some early investors some capital gains, right? And of course, it also means that we get to buy these things at discounts because they are illiquid and privately held, and they're older shares compared to the new preference shares within tech companies. So it helps us get in, and it helps us get in at value, at a good value proposition in our view, because you are able to buy these at discounts.
Thanks, Harold. I think this is a very good insight that people don't usually think about. Like secondary shares do provide opportunities for value because of the illiquidity. Next question is, does Indies Capital have a strict geographic focus in Indonesia?
It does not. I think if you look at the mezzanine side, certainly Indonesia has been a big part of the history, and that's why we have such a big on-the-ground presence. Our offices are basically split 50-50 in terms of staff between Singapore and Jakarta office. And the fundamental reason why Indonesia requires this capital is because there's a starvation for this type of capital and for sophisticated capital in general, I would say. And you've seen that in some of the charts. Right, the economy as a whole is actually under-levered, and the access to capital markets is also under-penetrated when you compare it even to the neighbors within Southeast Asia. We do, however, look at other Southeast Asian countries as well. So we've done deals in Thailand, for example. We've even done deals in overseas where you're supporting a local sponsor, but with overseas assets and financing needs. Okay. On the private equity side of our business, the niche fund in secondary technology, That is broadly Southeast Asia. So that one is not Indonesia focused at all, although Indonesia still remains a big part because it is the biggest economy within Southeast Asia.
Thanks, Harold. I think this question goes to Danny. Somebody asked, Alexis actually asked, they understand that there's bankruptcy laws in Indonesia and nuances like that. Has Indies or have you actually had to recover any defaulted loans, and how do you do that?
Through the bankruptcy. Okay. Yeah, I think we've been fortunate enough that throughout our history, we have only needing to do it one time. And it was a successful one. I think just to step back that, typically, almost always we would like to structure our deal with offshore element also. So although the asset is in Indonesia, there's a few technologies of doing the structuring where you can, have a layer of offshore companies where you can enforce offshore to gain control of the local companies. So in that particular situation, we managed to do that. So we get control to the offshore structure, and then we followed through with the onshore enforcement, and it was pretty smooth. Yeah, but I would say that's an exception rather than the norm. I think everything else that we've done, we managed to avoid that route.
Does Indies invest by giving financiers financing and provide advice at the same time to the company that you invest in, or is it just from a pure financial perspective?
Yeah, so we try and do both, frankly. And by the time we end up making an investment, generally, we've gone through a couple of months of due diligence to understand the industry, to understand the sponsor. And so, we try and give our value add where appropriate. Sometimes we do even have board representation or board observer seats. So we're a little bit differentiated, I think, compared to standard, financing providers. And in fact, we have a live situation currently where we're helping the company do its next round of funding. Right? As an investor, I think we want to back our companies and our founders.
Next question is from Trevor. With a small team size, how do you originate deals efficiently, given that Indonesia is a large market?
Yeah. So I think team size is all relative. Believe it or not, we feel we probably have the largest on-the-ground team in Jakarta, in Indonesia. So a lot of competitors in this space, as well as some of the banks, they don't have many people actually on the ground in Indonesia, right? We have seven or eight people on the ground in Indonesia. That is actually considered a fairly large team that is able to originate. And if you look at the profile of people we have in the firm, in a sense, they're very similar to Denny and myself and the other partners. We've all educated overseas and worked at top-tier financial institutions, investment banks, private equity funds. And so the capability of the team is both in origination as well as structuring. So it's important to have, I think, a mix of both within our business line. And so we've been fortunate, I think, with the team that's been built up. I think people are generally capable on both sides, right? And if you look at our history of deals, and you can probably see from our AUM and our history that we've done a fair share of deals, particularly over the last 7-year cycle, let's call it. I would say over 90% of deals is originated by Indies. So we don't rely on brokers. We don't rely on that kind of broker network.
This question is from Richard, maybe for Danny to answer. You spoke about mezzanine downside protection during your presentation. Maybe you'd like to elaborate more or share more about this mezzanine protection, downside protection.
Okay. Yeah, I think the biggest part of the downside protection that we talk about is in the form of the collateral, right? So I think in our mezzanine structure, we always have a collateral from the counterparty, and it can be in many different forms. It can be hard assets, can be equities, shares of the companies, also. And then secondly, we typically also have a recourse. So on top of the security, we also still have additional recourse, typically from either the sponsors, him or herself, or from the holding company of the counterparty. And then lastly, as Harold mentioned, also the nature of the product is a self-liquidating product with a defined tenure. So that's, unlike private equity, which is more open-ended on the exit, this one has a defined, schedule and maturity on exits.
I see. So there's another question also from Richard. The question is, personal relations seem to play an important role. Is that actually a competitive advantage for mezzanine funds?
Yeah, I think for us, clearly, as Harold mentioned, given our background, that we are mostly locals and been covering this local market for many years throughout our career in with other firms. But I think uniquely to us, not only we're local with local relationship and knowledge, but we also have strong product knowledge, because all of us work for international financial institutions in the past. So we tried to bring the hybrid model of combination of international background with local connection.
Yeah, that's a very good way to leverage our knowledge as well as on the ground implementation. So what are your expectations for the industry in the next 6 months or so?
Yeah. So I think for the next 6 months, we're still actually quite careful and quite cautious. As we spoke about earlier, I think some of the real economy impacts are still to come. We've seen a lot of stimulus. We've seen a lot of buffers being put in by the governments, which absolutely is the right thing to do, to take away the big shock and the big impact. But what that means is there may be a little bit of a delay, right, in terms of the real economy impact, right? And we're really starting to see that coming through. At the same time, we are seeing actually a lot more opportunities. So, we are extremely busy as a team right now because the level of discussions has suddenly accelerated, right? Because the COVID impact has obviously started to hit businesses and started to hit balance sheets. So we're being careful and cautious, but at the same time, I think in the next 6 months, there's going to be more and more opportunities to be done. So our perspective is, let's be conservative on collateral. Let's try and cherry pick partners and business groups and business models that will survive, and really, in effect, go up the credit curve a little bit, right? So take this opportunity to perhaps target the same level of returns, but with better sponsor groups or better collateral, right? So you lessen the risk for the same amount of returns.
Thanks for the perspective. Next question comes from an anonymous, potentially someone who is looking into venturing into investing in mezzanine funds. How does mezzanine actually help one to diversify the entire portfolio?
So I think the biggest differentiating factors were the ones we kind of went through, right, on the presentation. So it's much shorter duration. There is no J-curve impact, right? So if you invest in a lot of private equity style funds, I think most people realize that it's a very long-term game, right? And the investment horizon is 4 to 6 years. I think when you put money in the fund, you don't really expect any returns until year 6, year 7, year 8, perhaps. Okay. And of course, your end exposures when you're investing in equity is the underlying currency of these businesses, which means perhaps Indonesian rupiah, perhaps Malaysian ringgit, so on and so forth for Southeast Asia. So the benefit, I think, of a mezzanine fund is that, first of all, we have constant distribution. So it's a mix of fixed returns via coupons or interest on a regular basis, as well as a defined tenure. So the expectation is not 5 or 6 years, but more 2-3 years that you should get your capital back, right? You still enjoy some equity upside, but you get your capital back much, much sooner. And it's your US dollar denominated products. So you're not facing the FX risks. And because of that, you will see basically no J-curve impact in mezzanine funds. Okay, and the DPI is very strong. So the DPI when you invest in these funds are very strong. So perhaps as a diversification strategy, it fills a different part of the capital structure and allows you to recycle capital and recycle funds, because we do distribute, in effect, anything that we receive, which can be quarterly in nature, for example.
Thanks, Danny. I think this has been an amazing presentation, Harold and Danny from Indies Capital Partners. And the Q&A was certainly some questions asked were repeated a few times, just to let everyone know, which means that people are genuinely interested into what insights you bring through your experiences. So thank you very much for that. I hope that everyone here today enjoyed their post-lunch webinar, and do stay tuned for future webinars with iSTOX, where we have this weekly investment series to give people who are interested in private market investing more insight into what are the various asset classes, what are the trends, and we hear it right from the experts in this space. So thank you very much, Harold, Danny, and Indies Capital Partners. We will see you again in next week.
Thank you.
Thank you.
Thank you, Nigel.
Thanks, everyone.
Thanks, everyone.
Thank you.